Welcome and thank you for joining the 2025 Dollars and Donuts presentation hosted by LSA. My name is Michael Peters and I will be covering a high-level overview of property taxes in Iowa. We will be walking through the entire property tax process, beginning with the assessment of property market values to tax bills being issued and recent legislative changes. Throughout the presentation, you will see a variety of example calculations. These are meant for educational purposes only and are not meant as LSA recommendations. There are three primary concepts we need to cover before diving into our property tax system. Number one, like properties are grouped into 9 property classes, allowing each group to be treated differently in our tax system. These classes include residential, agricultural land, agricultural buildings, commercial, industrial, railroads, utilities, other, and gas and electric utilities. 2. Assessed value versus taxable value. Assessed value reflects the property's market value as determined by assessors, while taxable value is the amount subject to taxes after applying rollbacks and exemptions. 3. Assessment year versus fiscal year. There is roughly a 2-year difference between your property's value is originally set and when taxes are due. For example, a property assessed January 1, 2023 would have its property taxes due September 2024 and March of 2025, referred to as fiscal year 2025. In basic terms, assessment year 2023 has its impact felt in fiscal year 2025. On screen, you will see a graphic representing the distribution of the FY 2024 city revenues totaling $8.716 billion. The property tax process in Iowa follows a roughly 2-year process. First, local and county assessors determine the property's assessed value or market value and notify taxpayers. 2. Taxpayers are given the option to protest assessments to local boards of review. 3. The Department of Revenue adjusts jurisdictional values as necessary in a process called equalization to ensure consistent assessments are made statewide. 4. The taxable value is determined by a process known as assessment limitation, also referred to as rollback, where property classes are adjusted to ensure growth does not exceed 3%. 5. Local governments set levy rates for their budgets. 6. Tax bills are finally issued. Today, we will be primarily focusing on residential property taxes throughout the presentation's various examples. On screen, you will see a graphic representing the distribution of FY 2024 county revenues, which totaled $2.715 billion. Assessments are determined every 2 years and annually for utilities. 3 entities will determine a property's value depending on its property classification and taxing jurisdiction. County assessors evaluate the majority of property assessments to determine market value. Iowa also has 7 cities throughout the state that handle assessments within their jurisdictions. These include Ames, Cedar Rapids, Davenport, Dubuque, Iowa City, Mason City, and Sioux City. Third, the Department of Revenue handles the yearly assessments of public utilities and railroads. Market values are determined by these entities using 3 valuation methods, which include comparing a property to recent sales in the area, estimating the replacement costs of property or structure, and projecting income for a property, which is typically used in commercial or industrial property classes. Agricultural property is assessed via a productivity formula, which measures a property's capacity to generate income. To calculate this, we first determine its productivity value by taking a 5-year rolling average of crop prices per acre minus expenses. Next, we take the productivity value multiplied by the total taxable agricultural acres, which generates the total taxable value of agricultural land. Agricultural buildings are assessed differently than agricultural land. Here, we take the assessed value multiplied by the ag factor, which is a ratio of agricultural land production and earning capacity value per acre used to assess Iowa farm buildings. This ratio considers production, prices, expenses, local conditions, and the corn sustainability rating. Property owners have the right to dispute their assessed value if they believe it is inaccurate. Disputes can be filed annually between April 7th and May 5th of the property's assessment year. Disputes are reviewed by a local board consisting of 3 to 5 members. If a homeowner does not agree with the Board of Review's determination, they have the option to obtain an appeal to the state's Property Assessment Appeal Board or the district court. Equalization helps to ensure uniformity in assessments across Iowa. This process is conducted by the Iowa Department of Revenue in odd-numbered years in an assessment ratio study. The study identifies jurisdictions with a 5% variance compared to the state average and adjusts the class's assessment. In 2019, 3.1% of property jurisdictions were adjusted. In 2021, 26.4% were adjusted, and in 2023, 7.2% were adjusted. IDR releases this equalization report in September to guide these assessments. In the 2023 equalization order shown in the slide, Appanoose was the only residential jurisdiction on page 1 to be adjusted, increasing its valuations by 7%. Assessment limitation, also referred to as rollback, is a mechanism designed to restrict annual taxable value growth to 3% for residential and agricultural properties statewide and 8% for utilities. This mechanism provides stability and predictability for taxpayers by preventing large increases in tax bills when there are significant changes in property valuations. Increases in taxable value of agricultural and residential property is also restricted by a mechanism known as the agricultural tie, which essentially prevents one class from growing faster than the other. This agricultural tie limits both classes to 3% annual growth. Additionally, if the value of agricultural property decreases in a given year, the value of residential property cannot increase at all. Residential growth is also unable to exceed the growth percentage of agricultural values. For example, if residential taxable value grows by 3% and agricultural taxable value grows by 1% in a given year, both classes are restricted to 1% growth. If residential were to grow by 4%, but agricultural were to decrease by 1%, then the residential growth is restricted to 0. This graphic shows the historical changes to assessment limitations over the years. I want to highlight a few significant changes. Rollbacks were first enacted on agricultural and residential property classes in 1978 to address rapid property value increases, and annual taxable valuation growth was limited to 6%. In 1979, the commercial, industrial, utility, and railroad classes were added. Every class had a 6% limited growth, with the exception of utilities, which was limited to 10%. From 1980 to 2012, all classes were adjusted to a 4% limited growth, and utilities were adjusted to 8%. In 2013, residential and agriculture classes were limited to 3% growth. The growth restriction was removed for commercial and industrial classes, and the rollback was set to a static 95%, which was further reduced to 90% in 2014. Lastly, the multi-residential class was created in 2013, splitting off from residential valuations. It was later merged back into residential, and an amended residential rollback was introduced in 2022. A quick note on the graph: commercial and industrial rollbacks, represented by the gray and yellow lines, align from 2008 to present day. This graphic shows the difference between assessment year 2022 assessed valuations and fiscal year 2024 taxable valuations by class. Some highlights include: residential has a 2.7% increase in taxable valuation versus assessed valuation. Agricultural saw a 4.3% decrease along those same lines, and commercial saw a 3.9% increase. One quick note: the other slice of the pie includes both railroad and other property classes. Levy rates determine the amount of property taxes owed by taxpayers and are implemented by taxing authorities as they adopt their budgets by February 28th of each year. In fiscal year 2024, House File 718 established a consolidated general fund levy, which consolidated 19 different city levies. It also established a three-tier system which limited the growth of city taxes and incorporated levy caps for urban and rural areas. In FY 2025, Senate File 2442 further adjusted the three-tier system to a four-tier system, which we will discuss in later slides. The graphs on the right show the historic changes in the consolidated urban versus rural levy rates. Exemptions, credits, and abatements reduce the tax burden on eligible properties. Exemptions reduce the assessed value of properties. Credits reduce the taxable value, directly lowering taxes owed. And tax abatements provide temporary reduction in property taxes on a portion of the assessment. Some common residential examples include a homestead tax credit, which currently lowers a property's taxable value by $4,850. This credit is reimbursed by state dollars to local governments through the general fund. The homestead exemption, 65 or older, is in addition to the homestead credit. Qualified homeowners are exempt from $3,250 of taxable value for FY 2025. This further increases to $6,500 in FY 2026. This exemption is not reimbursed by state dollars and results in a reduction in taxable value for local governments. The military service exemption was expanded by House File 718 to $4,000 in taxable value starting in FY 2025. Similarly, there is no state reimbursement for this program. Abatements vary by taxing authority, but typically include a temporary reduction in value for new construction, improvements, or historical residence preservation. This graphic shows a residential property with a $200,000 assessed value and the resulting taxes owed when different exemptions and credits are applied. Example A is our baseline, showing a property without any exemptions or credits. This taxpayer would have a property tax bill totaling $3,068.51. Example B includes a $15,000 property tax exemption, which is subtracted from the property's taxable value. This exemption results in a $485.20 savings. Example C includes a $500 credit, which is subtracted from the final tax amount owed. This credit results in a direct one-to-one savings of $500. You can see by application of an exemption or a credit, you can achieve a similar tax savings on a given property. This slide has an example tax bill taken from Ankeny. The method of mailing and the required information was recently updated in House File 718. These changes are numbered on the example bill, and the order includes assessed value, rollback, taxable value, consolidated tax rate per $1,000 in assessed value, the net tax, payment due date, taxing authority information, tax distribution by taxing authority, total tax levied by taxing authority, and the percentage change of the taxpayer's bills. This example shows residential taxes which were assessed January 1 of 2021 and have tax bills due in two halves, the first being September of 2022 and the second March of 2023. Property taxes play a critical role in funding Iowa's schools and make up a large portion of school district funding. All properties are subject to a $5.40 uniform property tax levy per $1,000 of taxable value, which goes towards K-12 educational funding. Then, the state foundation aid comes in to backfill the district's funding up to the 88.4% foundation level, which is set by the state cost per pupil. Additional levy funds cover the remaining funding up to the state cost per pupil number. In FY 2025, the state cost per pupil was $7,826. This is a $191 increase from FY 2024. This increase is also known as the state supplemental aid. The graph shows the difference in property taxes collected, represented by the gray uniform levy and the teal state foundation aid for districts with high property values and low property values. It is important to understand here that when property taxes are reduced by the legislature, the state is required to backfill a portion of the funding from general funds up to that 88.4% foundation level. Likewise, increasing property taxes would decrease the contribution of general fund dollars. Tax increment financing districts are established to stimulate local economic development and maintain local control of property tax dollars. City or counties can establish a rural improvement zone by designating it as a slum, blight, and/or economic development area. Property taxes are then frozen at current levels, referred to as the base, and the growth in valuation over the next 20 years, which is referred to as the increment, can be used to incur debt to fund improvement projects in the area. All jurisdictions that participate are required to file a report with the Department of Management each year by December 1, and the Legislative Services Agency publishes an annual TIF report on February 15th. The creation of additional TIFs impact the general fund by increasing dollars required to backfill increment increases through the property tax replacement claims, which will be phased out after FY 2029, and through the application of the school aid formula previously discussed. This graph covers the revenues and expenditures of the TIF program from FY 2016 to FY 2023. House File 718, the Property Tax Assessments and Bond Elections Act, was passed during the 2023 general session. The act had a variety of property tax implications, which include the consolidation of 19 city levies into the new Consolidated General Fund Levy. This includes a levy limitation or reduction for fiscal years 2025 to 2028 based on the city's non-TIF taxable valuation growth compared to the previous year. Beginning in FY 2029, all cities will have a maximum CGFL levy of $8.10. This legislation capped levy rates to limit tax growth for cities and counties. Levy reductions are separated into 3 tiers based on growth. The Act also expanded the homestead credit and military service exemptions as discussed in previous slides, and created a new homestead exemption 65 years and older. Lastly, the Act introduced new taxpayer reporting requirements in the Property Tax Administration. Senate File 2442, the Individual Income Tax Rate Act, was passed during the 2024 general session. Highlights include an adjustment to House File 718's growth tiers for non-TIF taxable value, addressing disparities in tax contributions. This readjusted the tier system from 3 tiers to 4 tiers. The new system is broken down on the slide. The Act also updated the annual taxpayer statement notices and publication requirements as seen in the earlier Ankeny tax bill example. It also imposed additional deadlines and penalties for cities to certify their budgets. Counties are able to collect but not distribute any funds collected until the county budget has been certified and transmitted to the county auditor. Lastly, it created a new assessment limitation for pipeline utility company property. This rollback will decrease the actual value of this class by 2% per year beginning in assessment year 2025 and continue to decrease each year until it reaches its new 90% limitation in assessment year 2029. This concludes the LSA property tax presentation. I would encourage you all to visit the Fiscal Services Division website for more details on property tax legislation and reports found to the links included.